Hello, everyone. Welcome to the Equity Market Outlook webinar. And today we are conducting this webinar with Venugopal Manghat, who is the Chief Investment Officer for Equities for HSBC Mutual Fund. And he was previously head of equity investments at L&T Asset Management. And he also co-head. He was also a co-head of equity investments at L&T Investment Management. Before that, he was associated with Tata Asset Management Company. He's an MBA finance and he has a bachelor's in mathematics. So obviously, with an impeccable credentials, he is heading the equities team here in HSBC Asset Management Company. He's obviously the CIO, as I mentioned earlier. Now, just to give a background on the AUM of the funds which he manages with us. It's around 35,000 crore with the highest AUM of a small cap fund of around 15,000 crores. And then, obviously all of us know him as one of the, fund managers who manages the value fund. So with this background, and the webinar topic of equity market outlook, I would, start with this and welcome Venu to the webinar.
Thank you, Ashish.
So,
Happy to be here.
Yeah, and just couple of hygiene factors which I want to inform to my audience is that there is a feedback tab, for the questions which is visible on your screen. You can put in your questions there, and we'll try to take them at the end of the webinar. And at the end of the session, also you'll get a feedback tab, wherein you can put in your suggestions and give us a feedback on how the webinar was, so that it helps us improve in conducting the webinar in future. So coming back to the webinar and our topic today is the equity market outlook for Indian equities. Venu, can you give some insight on the key domestic factors which are there, which are impacting Indian equity markets? We have seen that there is a lot of volatility, uncertainty going on because of a lot of we see a lot of reasons which are there, the global and the domestic. Can you highlight some key domestic factors which you think affecting the equity markets positively or negatively?
Sure, Ashish. I'll start with the slide. This is a kind of summary slide of what you just asked. So good to start here. Over the last 6 to 7 months, from September 2024 onwards, you've seen the markets behaving in a very volatile manner. First, we saw the significant correction and then a recovery post March, April of this year. A lot of factors have played out. You've specifically asked about the domestic factors, but I think it started off with it started off on the domestic side with the slowdown in the economy post elections and post the monsoon. I think expectations had built up of second half recovery, but I think that got delayed and pushed out. That was probably the start, and that was the fundamental reason for the correction. But apart from that, I think the global factors also played a role. We didn't see so much of those factors playing a role till January of this year. Post January 15th is when the markets had the full impact of saw the full impact of the tariff negotiations and the announcements that came. And then, it continued for a month and a half where the markets really became nervous of, how the global economy is likely to play out. Till then, I think the expectation was that, U.S. economy would have a soft landing and then, grow at a reasonable pace. Global economy will muddle through, will remain stable and grow at a reasonable pace. That was the expectation till January of this year, post which obviously, things changed and all of us know what transpired. I think the expectations changed dramatically. On the domestic factors, I think, I mentioned the growth slowdown in the, for the Indian GDP, and the pushback or the moderation in capital expenditure we saw, and some of those factors are mentioned here. Consumption, we were all expecting consumption to really pick up by the second half of last calendar year, into the festive season and beyond that. But unfortunately, that didn't take place. Inflation remains sticky. Core inflation was low, but food inflation was fairly high, and therefore putting pressure. Domestic liquidity conditions tightened. There was a heightened concern, on the NPL formations from the unsecured loan book for NBFCs and banks, and I think that led to some regulatory pressures as well, and liquidity tightened very significantly in this phase the last quarter. FII flows went completely against us, against the market. We saw FII outflows, significant outflows in the last quarter, and then earnings revisions that took place brought the fundamentals back to the fore, and we saw the markets correcting. Cut to April 2025, where we are. I mean, we just finished April. We are in May, but in April we saw some of those factors, reversing. We have seen, of course, the cut in global economic numbers or forecasts is there, and I'll touch upon that. But apart from that, the domestic factors have largely changed. Government capex is slowly coming back. I think this quarter numbers, January to March quarter, it has revived. We are expecting it to be, front loaded for next year. Welfare schemes have been announced. There have been tax cuts in the budget. We've seen boost liquidity from the central bank side. We'll go into more detail of all of this, but the simple fact is that a lot of the factors have changed for the good, especially on the domestic side. On the global side, the tariff negotiations and the tariff announcements have become a little more benign for India, in the sense that on a relative basis, India is better off with the tariff that has been announced. And I think we are negotiating hard for arriving at some consensus and a deal with the US, which would be very positive. So I think all the negatives probably confluenced in the last quarter of last calendar year, and I think a lot of those negatives are now behind us and turning positive. So we have a positive outlook on the economy and the markets going forward. Obviously, geopolitics and these changing policies and trends with respect to views on tariffs, etc., will continue to play a role in markets becoming volatile or remaining volatile. But that said, I think a lot of the fundamental factors are far more positive. I'll pause there, and maybe if you have other questions relating to some of these factors, I will expand on them. Ashish.
Yeah, right. Thanks, Venu, for that outlook on the domestic side. So at the start of your presentation, you said that there, before the domestic factors, there are certain global factors, and there are global macros and variables which are there. And of course, you touched upon tariffs as well. So on the from that perspective, from the tariffs, and we have seen the de-dollarization, the forex reserves of India increasing. There was a decline in the oil prices. All those global macros and variables were there, which came into picture. Can you take us through those and let the audience know what all things are happening on that front? And we obviously have seen a lot of news on the tariff side. So if you can throw some light there, it would help our audience understand what is going on the global front.
Sure. I'll start with the tariffs. So as you can see on the screen, we've had a lot of announcements since January of this year, and you can see some of those announcements in terms of the value of that for the US economy, and that you can see. And on multiple fronts, we've seen changes happening on a regular basis, both in terms of the tariffs on various countries and also on different sectors, all types of tariffs, and all of that we have seen in the last 3 months or so. And it's a story that is still unfolding, and we don't have a sense of where it is finally going to land, even though I think the brunt of, or the most significant impact of that, or the most significant negative part of that has played out. And we are now seeing some moderation in the view and the policies with respect to tariffs, because we have this pause with against the for the tariffs against China. We have this 90-day window for negotiating, and so a lot of that is now playing out, which is why the market's also far more positive. However, I think the first impact of the tariffs and the uncertainty, and I would say more of the uncertainty, because the um, what happens is that even if you have announced an increase in tariffs, that will play out over a period of time. By the time the US consumer gets products at a higher imported at a higher tariff, it would take a quarter or 2 quarters, and then, or in some cases even beyond. For example, for textile products, it would take 2 or 3 quarters before which some of these products will hit the consumer market. So it is very early to see the actual impact of these tariffs on the, in terms of data. But the impact we have already, to some extent, seen in terms of the economy and the, how it is progressing. These, clearly, these tariffs, and the higher the tariffs, the less benefit it is to the US in terms of, for the consumer. Probably these have been taken up with a view to increase the revenues, to improve the employment opportunities in the US, to have more manufacturing in the US, which has suffered over the last several decades. And but with that intent, this would have probably begun. But the fact is that manufacturing is not going to go easily back into the US in a hurry. And even if the expectations of revenues becoming stronger because of the tariffs are probably valid, you will have some of those, at least, even if it's not fully passed on, some of it getting passed on to the consumer, and therefore it becoming inflationary. So there are significant disadvantages with this type of policy, but that's what they've chosen, and that's led to the uncertainty and volatility in this period. Hopefully, we have seen some sanity coming back. Again, I have to mention this, that we have not seen the end of the story. There is still, it's just a window for both parties to negotiate, and even for sectors like, for example, for pharmaceuticals or other sectors, we've got these time window wherein there can be some deal that takes place, or a negotiation that takes place to finally come to a number. So this will go on for some time. It will unfold, and hence I think we'll have to continue to live with this volatility and a little bit of uncertainty. um, Ashish, if you have anything further from the overseas side, or should I continue?
Yeah, Venu. You can maybe throw some light on the dollar. Obviously, a lot of things have been talked about how the US dollar is behaving, and what all effect has that taken into account for our forex reserves. Obviously, we saw OPEC plus increasing production, and then there was a decline in the oil prices. How do you see those coming out, and how do you see those affecting, and can you throw some light on those factors as well?
Yeah, sure. So if you see, the as I earlier mentioned, the impact of tariffs would be significantly negative on growth, and on inflation, higher inflation and lower growth, which is the most likely outcome with these level of tariffs. But we don't know whether these will continue, or it'll be cut down. Across the board, I think most economists have cut down the forecasts for GDP growth in the US, and the IMF has cut down its forecast, fairly significantly, to, I think, 1.8% for the US for calendar year 25. These numbers are, from UBS. Probably they are slightly more negative or bearish on the global economy. So they've cut down from. This is on the left hand side. You can see the chart on global GDP, or global economy. The change that took place from April 1st to 15th or 20th of April. We've seen a significant cut. This is after 2 or 3 iterations already in the first 2-3 months of this calendar year. So the numbers have been cut here from 2.9 to 2.55. IMF has also cut down. I think the numbers have been brought down from 3.3, if I'm not mistaken, to about
Yeah.
2.8 to 2.7. And I think you can see that most economies are getting impacted because of this. On the right hand side, you can see some numbers on for different economies and how this has played out before April 2nd, which was what was termed as Liberation Day, and then the current set of numbers. And the Indian GDP growth has also been lowered. UBS has an estimate of 6%, but I think most of us believe that India can grow at 6.25 or 6.5%, if not better, if not more. If a lot of these factors that I earlier mentioned play out, and we'll go into those in more detail. The point to note here is also that some of the numbers when it comes to China or European Union are actually cushioned by the fact that there is a possibility, and the announcements have already happened, of significant stimulus for these economies, especially for China and for the European Union. We have heard of Germany stepping up defense expenditure. Their again economies stepping up investments into infrastructure, etc. So I think there is a little bit of cushioning from those investments and those announcements, which is moderating the negativity that is there. Maybe that's a good thing, with the fallout of all of these tariff negotiations and tariff announcements have been that it has woken up China, it has woken up the European Union to do more for their domestic economies, and probably that is a positive to stimulate economic growth. If I look at, you asked about the dollar and the weakness in the dollar. I think one of the immediate impact that we have seen on the from an economy perspective is actually the currency, which was very, the US dollar was very strong between the September to December or January period, where it appreciated against most other currencies, including Indian currency. The INR went to as high as, I think, 88 half or 89. And then from January 15th, I think there was this increased fear that this is likely to be counterproductive, all these tariffs, and the negativity with respect to the expectation on growth and inflation started playing out, and we saw a reversal of the trend for the US dollar. You can see that trend on the right hand side, and all of this has happened in a very short period of time. You can see how even the Economist magazine has reversed or changed its view. The front page clearly shows a very different picture between two dates, which are not really very far between them. On the right hand side, you can see the dollar index depreciating against other currencies. The dollar index is US dollar against, I think, 12 other currencies, global currencies, and these include the large ones, more stable ones. And from it went as high as 109, and then dropped to below 100 in a very short period of time, and continues to remain weak. So if these tariffs continue, I mean, the increase in tariffs to 145% against China, etc., continue, then we would clearly see this trend continuing, the weakness in the dollar continuing. May not be in terms of actual numbers. Maybe it'll go sideways or move down for a period of time. This is both positive and negative for our economy, because this improves. On the positive side, it improves the current account deficit. It improves our inflation numbers quite significantly. We import a lot of oil. Oil prices are down, but besides that, we have the dollar loosening its strength, and those are very, very strong positives for the economy. But on the flip side, when you look at the earnings numbers, we have exporters as a large, significant component of the Nifty earnings, and exporters could suffer with the appreciation of the Indian rupee against the US dollar. So both the positives and negatives, I would say the positives outweigh the negatives. But that's where it is. We'll see where it where it goes, how this progresses. But I'm still expecting the currency, the US dollar, to remain weak, maybe in a range after this fall that we have seen. Is there anything I missed,
Yeah.
Ashish? Yeah.
No, so sure. Thanks, Venu, for that. And like you talked about the oil prices, could you also take us through in terms of and obviously you talked about the current account deficit of our country, and we have seen obviously now on the screen is the forex reserve slide. So can you take us through your views on these macros as well?
Yes. We had a challenging time between September and December. I spoke about the liquidity conditions tightening in the market. What added to that pressure was the fact that the central bank had to intervene. With the currency depreciation, US dollar was appreciating during that period, and the central bank had to step in and moderate that, which led to a loss of forex reserves, significant forex reserves. I think close to 40 or 50 billion we lost during that period for the purpose of stabilizing the rupee. We have seen a reversal of that in this period. I think we have seen and of course the FIs have been selling for quite some time, and that led to again pressure. But a lot of that has reversed now. We've gone back in terms of forex reserves. We have gone back to, I think, close to $680 billion or so, 680 or 690, close to $690 billion. I think it's just very short of, I mean, very a small percentage short of the all-time high, which was probably, I think, 700 plus 704, if I'm not mistaken. $704 billion was our peak in terms of forex reserves. I think we are very close to that. You can see that the import cover has also improved. We have one of the largest forex reserves. We are in fact, the fourth largest, and our cover for imports is close to 13 months now, which is very, very strong. So I think the external position has improved very dramatically. Our current account deficits have reduced. The expectation is that this will continue for the calendar year 2025. The expectation is the current account deficit will remain low at close to 1% or so, which is very much under control, and therefore the currency will also remain fairly stable. So I think on the external front, and I'm not counting any large foreign inflows, foreign portfolio flows, or FDI flows at this point in time, because that's again a story that will unfold over the next few months. I'm quite optimistic that that will happen, but that will actually be significantly positive if and when it happens. Right now, we're not counting on that. With the in the current scenario, with what we have, data we have, I think the expectation is that the current account deficit will remain well under control, well within that 1% range. So I think it augurs well for our economy. Most of the macros have turned quite positive.
Yeah, sure. Thanks, Venu, for that.
You
Yeah. So
Should I
moving
speak
towards
on the
oil
oil?
prices. Yeah.
Yeah, so I think oil price again, not just the currency, oil price declining to $60 and briefly going below 60 and stabilizing at 60 to 65, is extremely positive for us because we import a significant percentage of our requirements from overseas markets. Um, the sensitivity numbers are there all over the place. I think you will probably would have seen some of those numbers. A $10 cut in oil price would lead to about 40 bips gain on the current account deficit. Similarly, a 10% cut on oil price will lead to a 30 bips reduction in inflation numbers. And if some of those are passed on to the consumer through auto fuels, petrol and diesel, then obviously that will improve the ability of consumers to to buy and use. So demand also can pick up from there. So a lot of benefits with crude prices being low. Here in this chart, we've seen we put together the correlation or the movement of crude, our market, the Nifty against the Brent crude price, and as you can see on the chart, there is an inverse correlation to a significant extent. As the crude prices have dropped, the expectation of the Indian economy gaining significantly then leads to and then that leading to better numbers also for sectors and companies, clearly leads to a better market. And so there is a inverse correlation between oil prices and the Indian equity markets, and that's something again which works well for us in this calendar year. The expectation is that with the US really talking of more exploration and drilling, and if there is any thaw or kind of settlement between Russia and Ukraine, and that war stops, then I think we are looking at a very, very benign scenario for oil price. Not just oil, I think the entire energy sector. So that augurs well for India, and the Indian economy and the Indian markets.
Sure,
Ashish.
sure, Venu. Thanks for that. Yeah, yeah. So that was a very good overview and summary on the global factors, the macros and the variables which are impacting, not only globally, countries across the world, but also obviously India, because we are more worried on what is happening in the Indian markets, in the Indian equity markets, and how should we look at those variables.
Yeah.
So thank you for that. And now obviously I would also want you to give us some highlights on the domestic macros. And we always see that the usual suspect there is inflation, which plays out a lot of times, and it worries a lot of investors. And then obviously we are now coming to those months wherein the monsoon will come, and what are your views? And if you could give us something on the monsoon front. Are there any forecasts which have been given? And connected to that is obviously liquidity in the markets. So your comments on those, please.
Sure. So inflation has already seen a significant low. In fact, the CPI numbers for March was at 3.34, which is the reported number. That's I think more than a 60-month low, which is so which means that that's a 5-year plus low, which is significant. I think the expectations going into April also is that it'll decline even further to closer to 3.2 or so. That's just the expectation in the markets. What was very sticky in the last quarter of last calendar year was food inflation, and especially vegetable prices. I think those have also come under control significantly. Prices of pulses, cereals, food in general, vegetables, all of that has declined, and it has a significant contribution to CPI, and that is well under control, which is in addition to the crude oil price and the rupee appreciation that we are seeing, which helps the inflation further. I think all of this clearly helps the inflation numbers. The expectation, which I think the central bank has also put out, is that inflation will remain under 4% for most part of this financial year. There is also the higher production of food grains and monsoon, which is expected to touch the southern coast by end of May, a few days ahead of schedule, and the Met Department and SkyMet and everybody has forecasted more than 100%, 105% of average, long period average. Again, there are factors which play a role in the overall monsoon for a season for the country, and the spatial distribution matters a lot, apart from just the quantity of rainfall. So we need to wait and see for a few months once it starts as to how it progresses, and there should be no disruption because of excess rainfall in different states, like we had some in some place of last year. Last year, in fact, the September quarter saw disruptions because of heavy floods and heavy rainfall in some states, which impacted even mining. So those are some negatives if we see, if there is excess rainfall. So we'll need to see how this progresses, but suffice to say that the forecasts are very positive, and inflation numbers are dropping, expected to still further decline as we go forward. You
Right.
can also, along with that, expect more rate cuts from the RBI. We've seen two rate cuts already. The expectation with these kind of numbers, and with the positive intent that I'm seeing from the government and from the central bank to improve growth rates, my belief is that there could be more than what the market is expecting for this calendar year in terms of interest rates, interest
Right.
rate cuts, because inflation is also dropping. Yeah, Ashish.
Right, sure, Venu. And in fact, if you talk about rate cuts, and we have seen, in the last monetary policy meeting of RBI, that they have actually changed their stance from neutral to accommodative, and they're talking about more rate cuts, and they're infusing more liquidity in the market.
Yeah.
So that's what we have seen. Could you give us more highlights, some numbers on that, and how is it impacting the liquidity?
Yeah, so you're right. I mentioned the last quarter of last calendar year, liquidity was tight, and there was regulatory pressures on some of the sectors, including, the NBFCs and the microfinance sector had a bit of struggle in that phase. Plus, there was this, the scramble for deposits from the banking side. Banking liquidity, clearly was under pressure, which even impacted our credit growth as well. So it had a bearing on credit growth as well, which dropped from 16% to about 11%. But the more positive news is something that we should focus on, which is that the RBI has done significant measures in this period, and especially in the last few months, to improve liquidity. You can see some of those on the chart on the left-hand side. Two rate cards, the CRR card, there have been OMO purchases, swaps, all kinds of things have happened, repos. And the system liquidity has now turned to surplus, which is a big positive. And again, this has a bearing on the market, the internals of the market, because I believe strongly that the broader market, which is the mid and small cap part of the market, performance, depends significantly on the liquidity. And I think with stronger liquidity in the system, and I'm expecting credit growth also to start picking up, and the broad markets to also recover with this
Right.
positive liquidity.
Right. Sure, sure, Venu. And that actually, puts up a very better scenario of a improvement in the economy, in Indian economy. And obviously it would augur well for the consumers as well. And obviously, like you talked about liquidity, and putting in more liquidity in the system puts more money in the hands of the people. But that's, from the monetary side of it, and from RBI's. What are your views on, the capital expenditure which the government does? And because, it's the primary weapon in the government's hand to, which boosts spending. So are we seeing some light there? Are we seeing capex going up? What's your take on that?
Yes, you're right. I think investments has been the big driver of growth for the economy, and for a good reason for the markets as well. For the last 2 years or 2 to 3 years, the central government has taken the full, a heavy lifting, or has done the heavy lifting when it comes to doing the capex, because the private sector has not been really into this capex cycle yet, and state governments have been, have also been doing their part, but central government has actually been taking the full pressure. We've seen the last year numbers moderate, given the first half moderation in capex from the central government, and that is, for a known reason. First quarter we had the elections, and second quarter the monsoons, and that disrupted the activity levels. Then of course the higher spend on social welfare, etc., also put a lid on the further expansion of capex. And but having said that, I think this is a trend that we see in most election year periods. You can see on the right hand side chart in 2019-20, when and the current the election year 24-25, we've seen the same trend of capex dropping and then picking up later on. We've already seen that happen in the first quarter of this calendar year. My sense is that the people talk about the shortfall that is there with respect to the budgeted numbers when it comes to government capex. My sense is that it is largely to do with some items which are not as material for capex. I mean, including the money that was likely to be injected into BSNL, and then there was a provision for the Department of Economic Affairs to spend some money on new schemes. So those things have not really played out as was expected. Some other sectors have also been impacted. For example, roads, and some of the sectors have seen maybe a plateauing out of the spend in this cycle. I don't think we've seen the end of capex in any of those sectors. We have still a long way to go. But I think the focus now has shifted to, we've been doing a lot of stuff on the railways, but I think the focus is now on metro, focus is continuing on the power sector, including renewables, focus is more on defense spending, data centers, technology. A lot of those things are moving much faster, spending more. Money is getting absorbed in those investments, and it's already, you can see that. My sense therefore is that the next year numbers should be much better. In fact, the first half numbers of for financial year 26 should be significantly better, given the low base of last year as well. And I think this is helpful for the entire capex driven sectors within the market as well.
Right. So do you think that obviously the central government is doing all the heavy lifting and doing all the capital expenditure? Do you think that the states should also come into the picture? Do you have what are your views on if it's only the central government which is going to do something, or the states are also going to step into the picture and do something?
Yeah, I think the government wants the states also to participate, plus the private sector to also come back on track. Government capex as a percentage of GDP is already at 3.1, which is probably where it can remain for some time. I don't think they are intending to really take it to a higher level in the immediate future, given the needs of the economy. But the states can do more, even though I must also say that states are now doing much more on welfare than and are hard pressed to do that, and therefore the pressures for keeping aside that money for those things than for investment. So I think the baton is getting passed on to the states for capex. We'll have to wait and see how much the states will do. The general intent or the focus from the states are now far more on capex and infrastructure than what it was 10 years ago.
Right. Right. So I think, yeah. So states should obviously go ahead and do those spendings as well. It'll augur well for the economy. Having said that, we all saw that there was this production linked incentive PLI scheme, which was released by the government of India, and then they are also trying to do something on the semiconductor space. We have all seen it was released like almost a month back. So can you throw some light on how it was successful, and what are the future initiatives which the government wants to do there?
Yeah, I think we've seen the scheme had a overall outlay of about $28 billion over spread over 15 different sectors or so. Some sectors have been given more priority than the others, and therefore the allotment or the allocation was bigger. We've not seen so much disbursed till now, and I think of the 14 or 15 different sectors, 10 sectors are likely to see the scheme ending in 26-27 financial year, and the remaining four or five are possibly likely to see those schemes ending in financial year 28 or 29. But my sense is that the government is, taking the benefits of this, seeing the benefits of this in terms of employment generation, in terms of the increase in market share that we are getting in the global markets, especially in sectors like electronics, where we were big importers in the past, and now we are exporting significantly mobile phones, etc. We all know smartphones. We've become one of the larger exporters in the world. So I think there is likely to be a some evolution or a change that will take place in these schemes over the next 5-7 years, but the government is likely to continue with this kind of incentive for manufacturing, and that, I mean, they've seen the benefits of that for the economy.
Yeah, sure, sure. Thanks, Venu, for that. And as we talk about spending regarding the capital expenditure, the RBI putting money in hands of the Indians by increasing liquidity. Could you also cover a bit on if the government is indeed giving money in the hands of the consumers? Have they done something on obviously you talked about the welfare schemes. Could we have some light on those things? There have been announcements of the income tax relief, which will
Yeah.
put in more money in the
I
hands of the consumers.
Yeah,
Yeah,
Ashish, I will spend less time on this because I think this is well known.
right.
The income tax reliefs are known to everyone. I think most of the states or many states have announced some of these cash transfers, so that's known. What is not spoken about as much is the eighth pay commission, which is likely to kickstart soon, and the work on that. And that is, I think, going to be a big, driver of consumption growth, I believe, given that, the public sector has about 40% of the jobs in the country. And I think the increase in wage bills, and, the increase is actually expected to be fairly significant, at about 4.5 trillion rupees, which is about 1.2% of GDP. From the income tax relief, you're looking at 1 trillion rupees, and from the cash transfers, again, another 2 trillion rupees. While this seems very positive, I should also mention that the some of the states are struggling with respect to their balance sheets, and therefore the cash transfers look a little bit of a tough one for a few of the states, for sure. But overall, I think the numbers really stack up well. We're looking at upwards of 2% of GDP in terms of stimulus for consumption, and therefore we like sectors within consumption, especially the discretionary consumption for the from a market side.
Sure, sure, sure. And thank you, Venu, for the macro story covering both the global and the domestic side. And obviously, macro is one of the things, and obviously everyone would want to understand its impact on the Indian equities. So coming to the earnings season is going on. Can you throw some color on the Nifty earnings, and some of your commentary on the sectoral plays and the how it's impacting the sectors there?
Yeah, sure. I'll capture this in briefly. I think
Sure,
the Nifty earnings has seen a bit of a moderation in the financial year 2025, for obvious reasons. The first half was reasonably weak, and then the third quarter also has not played out as well. So we saw even the GDP growth going down to the lowest in the third quarter, and then um, uh, and Sorry, the second quarter, and then the third quarter onwards, we've seen a bit of a recovery, but overall numbers are still getting cut. So we're expecting the earnings growth for the Nifty to be close to mid single digits, or maybe low single digits. I would say for financial year 25, we think this is a kind of moderation in the whole cycle, a little bit of a pause before the it starts gaining again. On this base, lower base, we think the financial year 26 numbers will continue to see the a pickup in earnings once again. And I think we are looking at close to a mid-teen or early teen kind of growth for the Nifty earnings. You asked about the sectors, and I'll again touch upon this briefly. We saw, if you look at the 12-month period to April 25, from last April to September 24, you saw some of those, sectors which were doing well, which were expected to really catch up, doing quite well, including the consumer discretionary names. You had good participation from the capital goods space. We had good participation from real estate, etc. Cut to the October 24 to April 25 period, we saw a complete reversal, a mirror image of what was there in the April to September 24. So we're seeing sector rotation in play, which is not a very easy time for fund managers to construct portfolios, because in a very short period of time, you see market cap changes, you see sectors changing, and you have significant uncertainty. This is also seen in the year-to-date performance of sectors. You can see that the Bank Nifty has done the best. This is from, from January onwards, year to date. I think the banks, for a long period of time were underperforming and had valuations which were relatively cheaper. The what is shown as NSE Infra is the Infra Index, but if you go into that in more detail, you will see that that's also largely the large cap index names within the Nifty, or within the infra universe. And that is something that is done, better in this period. The smaller names within infra has actually been, some of the worst performers during this phase. Then you have the defensive sector, the consumer staple space. That's been kind of flat performer, and then the IT and the real estate space has been the biggest hit. Obvious reasons. I think real estate obviously is taking a little bit of a moderation or a pause in the cycle again. I would think that the story is still unfolding. The growth is still likely to be fairly strong over a period of time. We are seeing, post the takeoff that we took place after COVID, the inventory levels have come down significantly, and we've seen some price increases across some states and some cities, and we've reached a point where there is a little bit of plateauing. My sense is that the upper end of this market is still doing well, while the lower end, the affordable housing segment, has not really contributed as much. With the measures taken in the budget, with the interest rate cut, with the inflation dropping, with more wage hikes and things to come, I think the space should improve as we go forward. IT is a sector which is a little bit of a question mark as of now. There is no big impact as yet on this space, but we've heard the commentaries from a lot of the companies which give orders to the IT space, and they have all postponed or have given some negative commentary. Not all of them, but that is something that we'll have to wait and see how it works out. But the fact is that this sector is corrected a little bit, and we are now closer to the lower end of the band, and to that extent, I think valuation support will come. So I'm not too bearish on this space. We are in fact kind of neutral to this at this point in time within our portfolios. Ashish, should I
Yeah.
continue with the given the paucity of time? I think I'll just talk about the mid and small cap part of the market as well, since you asked about the market.
Yeah.
We've seen a kind of moderation in or in moderation in growth for the economy, and therefore some of the sectors that contributed to the mid and small cap part of the market. That plus the risk aversion because of the tariff pressures and global slowdown and geopolitics and all of that coming together in 3 4 months has played out, and we've seen the mid cap and small caps underperform over a 6 7 months period. Some of those factors, or many of those factors, are reversing now. We continue to remain, as a fund house, quite positive on the broad market space, on the mid and small caps. Obviously, valuations are higher there, but I think the growth opportunities are fairly significant compared to the larger cap names at this point in time. And I don't think the large cap names are so attractive in terms of valuations that the differential is so significant. So our sense is that the factors are reversing for good, including growth rates, including interest rates, inflation, liquidity. I mentioned to you that that's a big factor. Even the outcome of tariff negotiations, and if there is a settlement, I think that augurs well for a lot of the ancillaries and the vendor ecosystem for manufacturing, the
Right.
manufacturing sector. So all in all, I'm quite positive on the mid and small cap part of the market. Obviously, you need to be selective and
Correct.
cautious there with the volatility that is there on the global side.
Right. Sure. 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 When you and if you could also throw some light on the earnings and the valuation on both large and small and mid space, that would help us.
Yeah, sure. So I mentioned the financial year 25 numbers being muted for obvious reasons. 26 numbers are likely to be better on this base. We're looking at an acceleration again between the FY25 base to 27. We're seeing the numbers again growing strongly, and the growth rates again getting back into the trend that we've seen in the past, or getting better than the trend that we've seen in the past. A lot of the factors we've already spoken about. Um, when it you also asked about the valuations. I think the large
Right.
cap valuations are attractive, or are close to the long term average. So to that extent, we're not overly expensive, I would say. One good positive is that the ROEs have expanded, and some of it is structural. We have seen structurally, or I should say, interest rates are down. It's continuously coming down. If you look at a very long-term chart, and that's on the back of structurally lower inflation. Again, if you look at a very long-term chart, that's dropping, and policies are helping. And we've seen measures for improving GDP. We've seen measures directly influencing manufacturing, and therefore top line has expanded. We have seen margins improve because of commodities being benign. We've seen low leverage on the books. I think over the last 2 3 years, companies have made significant money. Promoters have made significant money. I think balance sheets have remained fairly stable and clean, and the leverage has dropped very significantly. So interest expenditure is not there from the balance sheet, from the companies, and tax rates have reduced. In 2019, corporate tax rates have been reduced significantly. So many of those factors are structural, and therefore I think the ROEs are expanding. I don't know how much more we can do in this, but the fact is that these are leading to higher valuations, and there are not too many economies where you will see these kind of positive trends emerge. You also asked about small cap valuations. I
Right.
think
Right.
they are above averages, and I'm sure there are many questions on these. Valuations are slightly expensive versus the large caps. Valuations are also expensive against the historic numbers. But as I mentioned, the ROEs are expanding. The growth opportunities are far better when you compare it with the past years, especially the decade between 2010 to 2020. I think when you compare with those years, I think the opportunities are far more significant, and the environment is far more conducive today. So I will pause there. Maybe.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.